the last few months have been quite rewarding in the financial markets, and we think there is good reason for that. If we look at the economic data, both in real terms and the inflation data, we're seeing a weakening in the economy, much weaker inflation, both lower than expected, and the Fed is beginning to change its tune. So just to rattle off a few of the statistics, JOLTS, the job opening index, is now dropping fairly precipitously. Temporary help employment is falling. That's a leading indicator. We did get the employment report today. It had something for everyone. I would say it was on balance a little stronger than expected, but temporary help, a leading indicator, continued to fall. It's been falling since the Fed started tightening. We had leading indicators. I think they're down now for 16 or 17 consecutive months, down about 10%. We have never escaped a recession when leading indicators have dropped 10%. We had retail sales, industrial production, existing home sales, new home sales, and capital spending as measured by non-defense capital goods, all negative on a month-to-month basis, mostly the month of October. We had the CPI and the PPI come in lower than expected. Now the PPI is up only 1.4% on a year-over-year basis. And so we believe that the Fed is getting ready to pivot. And we do believe, with history as our guide, that we'll look back at what happened during COVID and after COVID as transitory after all. And I think that's beginning to impact the thinking at the Fed as well. So that's been very good for the financial markets, both the equity market and the fixed income market. It has not been great for the commodities markets at all. And it has also been very good for Bitcoin and cryptocurrencies and crypto assets at large. So as usual, we'll go through fiscal policy, monetary policy, economic indicators, market indicators, and then we'll wrap up with a little discussion about innovation.
Hey, money talkers, we've got a wild ride in the crypto world. Bitcoin's making moves and Elon Musk is dropping some crypto wisdom bombs. Buckle up, hit that like button, and let's jump into the crypto roller coaster. Hold on to your Bitcoin crypto crew. Bitcoin is on a mission, and it's giving us déjà vu vibes from 2021. The recent surge in Bitcoin's price is like a blast from the past, echoing that historic bullish run. Despite FTX's drama and a rocky 2022, Bitcoin is flexing its muscles, doubling down on growth and eyeing a new all-time high. Why? Well, there's this little thing called pending ETF approval causing a buzz. Market traders are diving in, institutional players and retail investors alike. Options open interest is sky high, hitting a record $14.9 billion, beating 2021's high. And here's the kicker. Bullish bets are on, with folks eyeing Bitcoin hitting $40,000 or even $45,000 by December's end. Bitcoin is not just a coin, it's a financial revolution, shaping the crypto era with its constant surge in global demand. Get ready for the Bitcoin boom. Stop the presses, crypto connoisseurs. Elon Musk, our favorite Twitter guru, has a crucial message for all you crypto holders out there. It's simple, not your keys, not your coins. In the midst of all the crypto excitement, Elon's sounding the alarm. Owning crypto is more than just watching the prices soar. It's about owning your keys and, in turn, your coins. He's throwing shade at centralized exchanges, warning about the risks of losing control over your assets. And let's talk derivatives. They might sound cool, but they don't mean ownership. Elon's solution? Hardware wallets. These little guardians keep your keys offline, away from the online chaos. It's not just about the hype, it's about responsibility. By securing your keys, you're shaping a decentralized and empowered future for crypto. Elon's dropping knowledge bombs, and it's time to listen. And there you have it, crypto explorers. Bitcoin's rally and Elon's key reminder. The crypto roller coaster never disappoints. What's your take on Bitcoin's surge? Are you team hardware wallet? Let me know in the comments. Let's continue our discussion with Cathie Wood.
All right, so here we go. Fiscal policy. This is, again, the federal budget deficit as a percent of GDP. It is very high by historical standards, meaning the deficit, the more negative, the higher the deficit. And we now have a new Speaker of the House who has to navigate a very difficult situation between Democrats and Republicans. But one thing I believe will not happen, and that is big spending programs, even though we're going into an election year. Very often in an election year, spending programs pop up all over the place because it's an election year. And representatives, senators, others want to give their constituencies good news. I don't think that's going to happen this time. And I think, in fact, we'll probably see surprising spending restraint. So I think if we're right, what will happen is spending restraint, but the economy softens. So it'll probably stay in this range for a while until we enter a recovery. So let's move on then to monetary policy. So money supply started falling in July of 22 on a sequential basis. Since then, it has dropped 5%. Now, on a year-over-year basis, it's down roughly 3.5%. And you can see maybe it's ticking up a little bit, but that's only because we're now comparing against declines a year ago. So the so-called comparisons are getting easier. So very weak monetary supply statistics, and we're seeing the monetary base has dropped from, I think it was $8.5 trillion at the peak, to now about $7.7 trillion. So real shrinkage out there. Now, I've talked about velocity before. What has offset this decline and kept GDP growth moving up in the last year? It is this chart, velocity. The velocity of money has been moving up. And it's a cyclical move. So you can see the velocity of money, as measured by M2, peaked in 1997 and has been in a downtrend ever since. That typically isn't the case when real estate, industrials, and financials are the best performing categories. Worst were energy, it was the only negative sector, consumer staples, and healthcare. So those last two are more defensive categories. That does make sense in the context of how innovation-based strategies like ours performed. So it's been a great rebound from the lows in October, just a massive rebound, and has transformed the year for a lot of asset managers, either for the better or for the worse. And if we're right, and inflation is going to surprise on the low side of expectations, and growth disappoints, we'll be in a period where innovation does its best. Innovation solves problems. If you need to protect your margins as your pricing power disappears, then you need productivity-enhancing technology. And with the breakthroughs in artificial intelligence, and we marvel all the time about the breakthroughs in AI as AI training costs drop 70% per year. There's a boom out there, and that is what happens when prices drop. And prices associated with disruptive new technologies always fall. So it's a perfect environment for our companies to thrive. And I'll close right now by featuring two pieces we've put out recently. Both of them, interestingly, are on Bitcoin as we get ready for hopefully the SEC's approval of a spot Bitcoin ETF. We think it is going to happen. There are all kinds of signals that it's going to happen. So in a timely way, we put out our Bitcoin monthly in the last week. Check out the health of the Bitcoin network and the ecosystem broadly in that piece. And then we just released our latest Bitcoin brainstorm, which we are in partnership with the Bitcoin Park in Nashville, Tennessee. And those are opportunities for us to showcase the developers out there.
If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.